In 2008, the global financial system came within hours of collapse. Banks stopped trusting each other. Credit markets froze. Entire economies stalled. It was described as a housing crash, but the collapse was triggered by a structured finance scam built deep inside the banking system. Mortgages were issued to borrowers unlikely to repay. Those loans were bundled into securities. The securities were rated as safe and then sold across the global financial system. Risk was hidden. Profits were immediate. Losses were delayed. When defaults began, the structure unraveled everywhere at once. This was the 2008 mortgage crisis. At the beginning of the 2000s, the global financial environment entered a period of unusually low interest rates. After the collapse of the technology bubble in 2000, economic growth slowed across the United States. The Federal Reserve responded by lowering benchmark interest rates. Between 2001 and 2003, the federal funds rate fell from over 6% to nearly 1%. The goal was to stimulate borrowing and prevent a deeper recession. Lower interest rates made credit significantly cheaper. Households could borrow more easily. Mortgage payments became more affordable. Banks also found it easier to extend loans. This shift quickly affected the housing market. Demand for homes began rising across the United States. Home ownership had long been promoted as a central pillar of economic stability. Government policy also supported expansion in housing credit. Mortgage lending institutions began issuing loans at a rapidly increasing pace. Between 2001 and 2005, mortgage debt in the United States expanded dramatically. Home prices began rising across many metropolitan areas. The increase in prices reinforced the perception that housing was a safe investment. Borrowers believed home values would continue climbing. Lenders also assumed rising prices would protect them from losses. If a borrower defaulted, the property could simply be sold at a higher price. This assumption shaped lending behavior throughout the industry. Financial institutions became increasingly confident in housing markets. Mortgage originators expanded operations to capture new demand. Competition between lenders intensified. Institutions began searching for ways to increase loan volumes. More loans meant more revenue. More revenue meant faster institutional growth. At the same time, financial innovation was accelerating inside the banking system. New financial structures were being developed to distribute mortgage risk. Banks were no longer limited to holding mortgages on their own balance sheets. Instead, loans could be packaged and sold to investors. This transformation would reshape the mortgage market. The connection between lenders and borrowers began to change. Loan originators increasingly focused on generating new mortgages rather than managing long-term risk. The environment of low interest rates created the conditions for rapid expansion. Housing demand continued rising, credit continued expanding, and financial institutions began building the architecture that would later amplify the crisis.
As housing demand accelerated in the early 2000s, mortgage lending expanded rapidly. Financial institutions searched for ways to increase loan volumes. Traditional mortgage lending had focused on borrowers with strong credit histories. These borrowers typically provided documentation of income and stable employment. But by the early 2000s, competition among lenders intensified. Institutions began targeting borrowers with weaker credit profiles. These loans became known as subprime mortgages. Subprime borrowers often had lower credit scores. Some had previous loan defaults or unstable income histories. Under traditional lending standards, many of these borrowers would not have qualified for mortgages. But lending standards began changing. Adjustable rate mortgages became increasingly common. These loans offered low introductory interest rates during the first years. After the initial period, the rates would reset at higher levels. The lower introductory payments attracted new borrowers. Some loans also required very little documentation. Income verification was sometimes limited or entirely absent. These mortgages became known informally as low-doc or no-doc loans. In some cases, lenders did not fully verify a borrower's ability to repay. The focus increasingly shifted toward generating loan volume. Mortgage brokers were often compensated based on the number of loans they originated. Higher volumes meant higher commissions. Loan originators therefore had strong incentives to approve more borrowers. Banks purchasing these loans also benefited from expanding supply. More mortgages meant more financial products that could be created and sold. Between 2003 and 2006, subprime lending expanded dramatically. Millions of higher-risk mortgages were issued during this period. Many borrowers accepted loans with complex payment structures. Some mortgages allowed borrowers to make very small initial payments. Others permitted negative amortization, where loan balances could increase over time. For many borrowers, these structures were difficult to sustain once interest rates adjusted. Yet the system continued expanding. Housing prices were still rising. As long as prices increased, refinancing or resale appeared possible. This reinforced confidence across the mortgage industry. But beneath the expansion, the quality of the underlying loans was steadily deteriorating. The system was producing larger volumes of increasingly fragile mortgages. These loans would soon become the raw material for a much larger financial structure.
As mortgage lending expanded in the early 2000s, banks began transforming how those loans were financed. Traditionally, banks originated mortgages and held them on their balance sheets. The bank collected monthly payments and carried the risk if borrowers defaulted. But by the early 2000s, a different model had become dominant. Loans were increasingly sold into financial markets. The process began with mortgage-backed securities. Thousands of individual home loans were bundled together into large pools. These pools created predictable streams of mortgage payments. Financial institutions then issued securities backed by those payment streams. Investors purchasing the securities received income from mortgage payments made by borrowers. The concept appeared logical. Pooling large numbers of loans was expected to reduce risk. If a small number of borrowers defaulted, the remaining payments could still support the security. This process allowed banks to remove mortgages from their balance sheets. The loans were transferred to investors through structured securities. Banks could then originate new mortgages and repeat the process. This structure dramatically increased the supply of mortgage credit. Mortgage originators no longer depended on long-term funding capacity. Once loans were issued, they could be sold into securities markets. Investment banks became central participants in this system. They purchased large volumes of mortgages from lenders. The loans were then assembled into mortgage-backed securities. These securities were sold to institutional investors. Pension funds, insurance companies, and asset managers purchased them as income-producing assets. Mortgage-backed securities became one of the fastest-growing financial products of the early 2000s. They were widely viewed as relatively safe investments. Housing prices were still rising. Defaults remained relatively low. Financial models predicted stable cash flows. As demand for these securities increased, the demand for mortgages also increased. Mortgage lenders responded by generating more loans. This created a powerful feedback loop. More mortgages produced more securities. More securities attracted more investors. The system appeared to distribute mortgage risk across the global financial system. But the underlying risk had not disappeared. It had only been redistributed. The architecture of structured finance was becoming increasingly complex, and the stability of the system now depended on the continued performance of millions of individual mortgages.
As demand for mortgage-backed securities increased, financial engineers began designing more complex structures. Investment banks searched for ways to transform large pools of mortgages into multiple investment products. This led to the creation of collateralized debt obligations, commonly known as CDOs.
A CDO began with a large collection of mortgage-backed securities. Instead of selling these securities directly to investors, banks repackaged them into a new financial structure. The structure divided the cash flows from the mortgage pool into separate layers. These layers were known as tranches. Each tranche had a different priority in receiving payments. The senior tranche received payments first. It also absorbed losses last. This structure meant the senior layer appeared extremely safe. Lower tranches absorbed losses earlier if borrowers defaulted. These junior tranches carried higher risk but offered higher returns. The tranching system created the impression that risk could be carefully redistributed. Even if some mortgages failed, the senior tranches could still receive payments. Financial models supported this assumption. They estimated that housing markets across the country would not decline simultaneously. Under this assumption, widespread mortgage defaults appeared unlikely. Investment banks used these models to structure increasingly complex securities. Large pools of mortgages were divided into multiple tranches. Each tranche could then be sold separately to investors. Senior tranches attracted institutions seeking stable income. Junior tranches appealed to investors searching for higher yields. Some structures became even more complex. CDOs were sometimes constructed using pieces of other mortgage-backed securities. This created multiple layers of financial packaging. Risk became increasingly difficult to trace back to the original mortgages. To many investors, the structure appeared sophisticated and mathematically sound. Complexity itself became part of the product. But the underlying foundation remained unchanged. The entire structure still depended on homeowners continuing to make mortgage payments. If defaults rose sharply, losses could move upward through the tranches. The system appeared stable while housing prices continued rising. Yet beneath the financial engineering, the risk was accumulating across multiple layers of structured products. As mortgage securities and CDOs expanded, another institution became critical to the system: credit rating agencies. Investors relied on ratings to evaluate the safety of financial products. Large institutional investors often required securities to carry high credit ratings before they could purchase them. Rating agencies such as Moody's, Standard & Poor's, and Fitch played a central role in this process. These firms analyzed financial products and assigned risk ratings. A AAA rating represented the highest level of perceived safety. Historically, this rating had been associated with government bonds or extremely stable corporate debt. But during the expansion of structured finance, AAA ratings began appearing on large portions of mortgage securities. Even securities backed by subprime mortgages could receive high ratings if structured into senior tranches. Financial models suggested that losses would rarely reach those senior layers. As a result, large volumes of mortgage-backed securities were rated AAA. This rating dramatically expanded the potential investor base. Pension funds, insurance companies, and sovereign wealth funds often required highly rated assets. The rating effectively acted as a certification of safety. But the rating process contained a structural conflict of interest. Investment banks issuing the securities paid the rating agencies to evaluate them. This meant the firms creating the products were also the clients purchasing the ratings. Competition among rating agencies intensified the pressure. If one agency assigned a lower rating, banks could seek another agency willing to provide a higher one. This system encouraged more favorable ratings. Complex financial models also contributed to the problem. Many models assumed that mortgage defaults would remain geographically isolated. They also relied on historical data from periods when housing prices had rarely declined nationwide. Under these assumptions, large losses appeared statistically unlikely. But the models depended on housing prices continuing to rise. Few participants examined how the system would behave if housing markets declined across the country simultaneously. As long as securities continued receiving high ratings, investor demand remained strong, and the structured finance machine continued expanding. As structured mortgage securities expanded, demand for these products spread far beyond the United States. Investment banks marketed mortgage-backed securities and CDOs to global investors. Institutions across Europe, Asia, and the Middle East began purchasing these products. Many investors were searching for higher yields than government bonds offered. Structured mortgage securities appeared to provide that opportunity. At the same time, they carried high credit ratings. This combination made them attractive to large financial institutions. European banks became some of the largest buyers. Many institutions used short-term borrowing to finance their purchases. This strategy allowed banks to hold large portfolios of mortgage securities. Pension funds also became significant participants. These funds required steady income streams to meet long-term obligations. Mortgage securities appeared to provide stable cash flows supported by millions of homeowners. Insurance companies also increased their exposure. The securities were treated as safe assets within regulatory capital frameworks. This further increased demand. As global investors purchased more securities, investment banks needed additional mortgages. Mortgage originators responded by issuing more loans. The system had become a global supply chain. Borrowers in the United States were connected to investors around the world. A mortgage issued in California could quickly become part of a security held by a bank in Europe. This global distribution spread exposure across the international financial system. But it also meant that risks embedded in U.S. mortgages were now shared globally. Few investors fully understood the structure of the securities they were purchasing. Many relied heavily on credit ratings and model-based risk analysis. The complexity of the products made independent evaluation difficult. As long as housing prices continued rising, the system appeared stable. Mortgage payments continued flowing into the securities. Investors received steady income. Financial institutions recorded profits. But the stability depended on a single assumption, that housing markets would remain strong. If defaults increased significantly, losses would spread through the global network of structured finance. By 2006, this network connected banks, pension funds, and investors across multiple continents. The system had become deeply interconnected, and the risks embedded in subprime mortgages were now distributed across the entire global financial system. By 2006, the U.S. housing market had reached its peak. For several years, home prices had risen steadily across most regions. Borrowers, lenders, and investors had come to expect continued growth. But by early 2006, the pace of price increases began to slow. In some cities, housing prices stopped rising entirely. This shift created immediate pressure on the mortgage system. Many subprime loans depended on rising home values. Borrowers often expected to refinance before higher interest rates took effect. Adjustable-rate mortgages began resetting to higher payments. Monthly obligations increased sharply for many homeowners. Some borrowers struggled to keep up with these new payments. Mortgage delinquencies began rising. Initially, the increases appeared limited to certain regions, but by late 2006, the trend was becoming more widespread. Subprime mortgage defaults were increasing across multiple states. Lenders began reporting growing numbers of missed payments. At the same time, housing inventory started increasing. More homes were entering the market for sale, but buyer demand was no longer expanding at the same pace. Prices in several metropolitan areas began declining. For highly leveraged borrowers, falling prices created additional problems. Some homeowners now owed more than their properties were worth. Selling the home could no longer repay the mortgage. Refinancing also became more difficult. As defaults increased, lenders began tightening credit standards. Fewer borrowers qualified for new loans. This further reduced demand in housing markets. The feedback loop that had supported the boom began reversing. Falling prices led to rising defaults. Rising defaults increased pressure on mortgage-backed securities. Financial institutions began recognizing early losses on mortgage portfolios. By late 2006 and early 2007, analysts were warning about instability in subprime markets. Yet many participants believed the problems would remain contained. The global financial system still appeared stable, but the foundations of the structured mortgage system were beginning to crack.
By 2007, problems in the subprime mortgage market were spreading into the broader financial system. Mortgage lenders specializing in subprime loans began reporting large losses. Several firms declared bankruptcy as defaults accelerated. Investment banks holding mortgage securities began reassessing their exposure. The value of many mortgage-backed securities became difficult to determine. Financial markets rely heavily on confidence in asset pricing. When investors cannot determine the value of assets, trading slows or stops entirely. This is exactly what began happening in credit markets. Banks became uncertain about the financial condition of other institutions. Many institutions were holding complex structured securities tied to subprime mortgages, but few could estimate the size of the potential losses. Interbank lending began tightening. Banks grew reluctant to lend to one another. Short-term funding markets started freezing. In 2007, two hedge funds connected to Bear Stearns collapsed after large losses in mortgage securities. This event signaled that the problems inside structured finance were becoming systemic. Throughout 2007, mortgage delinquencies continued rising. Housing prices continued falling in many regions. Securities backed by subprime mortgages began losing value rapidly. Financial institutions attempted to sell these assets, but buyers were increasingly scarce. By early 2008, the crisis had entered a new phase. Large investment banks were now directly threatened. In March 2008, Bear Stearns faced a sudden liquidity crisis. The firm depended heavily on short-term funding. When lenders refused to continue financing, the bank could no longer operate normally. The Federal Reserve arranged an emergency takeover of Bear Stearns by J.P. Morgan Chase, but the crisis continued spreading. Throughout 2008, losses across the banking system expanded. Confidence in structured finance collapsed. Then, in September 2008, Lehman Brothers declared bankruptcy. The failure triggered a global financial panic. Credit markets froze across major economies. Banks stopped lending. Investors withdrew from risky assets. Within weeks, the global financial system faced its most severe shock since the Great Depression.
By late 2008, the financial crisis had spread across the global economy. Major banks were facing severe losses on mortgage-related assets. Credit markets had largely stopped functioning. Without functioning credit markets, businesses and households could not obtain financing. Governments began preparing emergency responses to prevent a systemic collapse. In the United States, policymakers feared that additional bank failures could trigger a complete breakdown of the financial system. Several large financial institutions were already under extreme stress. Mortgage-related losses were eroding bank capital. Investment banks dependent on short-term funding faced constant liquidity pressure. The failure of Lehman Brothers had intensified the crisis. Financial markets reacted with widespread panic. Credit spreads widened dramatically. Stock markets fell sharply across the world. Policymakers concluded that direct government intervention had become unavoidable. In October 2008, the United States Congress passed the Troubled Asset Relief Program. The program authorized up to $700 billion to stabilize financial institutions. Instead of purchasing troubled assets immediately, the government injected capital directly into major banks. Large institutions received emergency funding to strengthen their balance sheets. The objective was to restore confidence in the banking system. At the same time, central banks expanded liquidity operations. The Federal Reserve created emergency lending facilities for financial institutions. These programs allowed banks to access short-term funding when private markets had frozen. Central banks in Europe and other regions introduced similar measures. Interest rates were reduced to extremely low levels. Governments also provided guarantees for certain financial liabilities. These guarantees were designed to prevent deposit runs and restore market confidence. The crisis also introduced the concept of institutions considered too big to fail. Some banks were so interconnected that their collapse could destabilize the entire system. Governments therefore prioritized stabilizing these institutions. Public funds were used to support private financial institutions. The decision was controversial. Critics argued that banks responsible for excessive risk-taking were being rescued by taxpayers. Supporters argued that intervention was necessary to prevent a deeper economic collapse. The emergency programs succeeded in stabilizing the financial system, but the scale of government intervention was unprecedented. By the end of 2009, trillions of dollars in liquidity and guarantees had been deployed globally. The immediate crisis had been contained, but the consequences of the mortgage collapse would continue affecting the global economy for years.
After the immediate financial panic subsided, attention turned toward accountability and reform. Governments and regulators began investigating the causes of the crisis. Several official inquiries examined the structure of mortgage markets and structured finance. In the United States, the Financial Crisis Inquiry Commission was established in 2009. The commission reviewed millions of documents and interviewed hundreds of market participants. Investigators focused on mortgage origination practices, securitization structures, and regulatory oversight. They also examined the role of credit rating agencies and investment banks. One major question concerned criminal responsibility. Despite the enormous scale of financial losses, criminal prosecutions remained limited. Some mortgage brokers and smaller firms faced charges related to fraudulent lending practices, but senior executives at major financial institutions were rarely prosecuted. Prosecutors often argued that proving criminal intent within complex financial transactions was difficult. Instead of criminal trials, most enforcement actions occurred through civil settlements. Large banks agreed to pay billions of dollars in fines and penalties. These settlements addressed claims related to misleading investors about mortgage securities. Financial institutions also faced lawsuits from investors and government agencies. At the same time, lawmakers introduced new regulatory reforms. In 2010, the United States passed the Dodd-Frank Wall Street Reform and Consumer Protection Act. The legislation represented the largest overhaul of financial regulation since the 1930s. The law introduced stricter capital requirements for banks. It created the Consumer Financial Protection Bureau to oversee lending practices. It also introduced new oversight for derivatives and complex financial instruments. Large financial institutions were subjected to periodic stress tests. These tests evaluated whether banks could survive severe economic shocks. Regulators also introduced new rules for mortgage lending standards. Borrowers would now face stricter income verification requirements. Certain high-risk mortgage structures became less common. The reforms attempted to address weaknesses revealed by the crisis. But debates about the effectiveness of these reforms continued. Some analysts argued the financial system remained vulnerable to new forms of risk. Others believed the regulatory framework had significantly improved stability. The 2008 crisis, therefore, produced both institutional reforms and unresolved questions about financial oversight. The mortgage crisis revealed a structural pattern that appears repeatedly in modern finance. The pattern begins with an environment of abundant credit. Low interest rates encourage borrowing and asset expansion. Rising asset prices reinforce the perception that the system is stable. Financial institutions then search for ways to expand lending volume. New financial structures are introduced to distribute risk. In theory, these structures are designed to improve stability, but in practice, they can change incentives inside the system.
When loans can be sold rather than held, the incentive to verify borrower quality weakens. Loan originators focus on producing assets rather than managing long-term risk. Financial engineering then repackages those assets into securities. Complex structures make risk more difficult to evaluate. Credit ratings provide a simplified signal of safety. Investors begin relying on those ratings instead of examining the underlying loans. Demand for highly rated assets increases. Financial institutions respond by producing more securities. More securities require more underlying loans. Lending standards gradually weaken to maintain supply. The system expands as long as asset prices continue rising, but rising prices can conceal structural weaknesses. Borrowers with fragile finances remain able to refinance or sell properties. Defaults remain low during the expansion phase. Financial models interpret this stability as evidence that the system is safe. Risk appears distributed across many institutions. In reality, the system becomes more interconnected. When asset prices stop rising, the assumptions supporting the structure collapse. Borrowers begin defaulting. Securities backed by those loans lose value. Financial institutions holding those securities face sudden losses. Confidence disappears from funding markets. Liquidity vanishes across the financial system. Governments intervene to prevent systemic collapse. Public funds stabilize institutions that previously recorded private profits. This cycle has appeared repeatedly across financial history. The mortgage crisis of 2008 demonstrated how complex financial structures can magnify underlying weaknesses. When risk is repackaged instead of reduced, collapse is only delayed.